There is something critical that most people are completely overlooking right now, and it is draining money from your pocket every single month without you even realizing it. The federal government handed you an increase this year, a 2.8% cost of living adjustment, which works out to roughly $56 more per month in your Social Security payment beginning in March 2026. That sounds like a win, doesn't it? But before you allow yourself to feel relieved, let me show you exactly what was happening on the other side of the equation. At the same time, Medicare Part B premiums surged nearly 10%, climbing from $185 a month all the way up to $228 or $90. That right there is $70.90 a month wiped away before your raise ever touches your bank account. And for the millions of Americans who are collecting lower benefit amounts, the math is absolutely devastating. Your effective cost of living adjustment is essentially wiped clean, swallowed whole by the rising tide of healthcare expenses. And here is the figure that is genuinely catching people off guard as we move deeper into March 2026. Certain beneficiaries are seeing Medicare-related adjustments pushing their gross benefit figures above $2,434 a month on paper. But what actually gets deposited into their checking account is a completely different story. And that gap between what the government shows you and what you actually receive is something I want to spend real time explaining to you today. The maximum Social Security benefit in March 2026 can climb as high as $4,873 per month for those individuals who truly worked the system correctly and made the strategic decision to delay their claiming date. But the overwhelming majority of people never planned their way to that number. They placed their trust in the system. They believed the government had their best interests in mind. And now, they are sitting at their kitchen tables, going over their monthly expenses, wondering why their check does not stretch anywhere near as far as it used to just a few short years ago. I have spent 30 years in this field, and I am telling you with complete conviction that the numbers Washington puts in the headlines are not the numbers that are going to define your retirement. You need to understand the full and complete picture of what is happening to your money in March 2026 and beyond, because I promise you, nobody else is going to step forward and protect your financial future except to yourself. So, let me take you through exactly what is happening layer by layer so you can walk away from this conversation with clarity instead of confusion. I want you to close your eyes for just a moment and picture something. You worked for 40 solid years. Maybe you spent your career as a school teacher shaping young minds. Maybe you were behind the wheel of an 18-wheeler hauling loads across the country. Maybe you built a small business out of the spare bedroom in your house and poured everything you had into it. You paid into Social Security on every single paycheck year after year. You never asked for a break. You never complained. You trusted that the system would be there for you when the time came. And now you are retired, living on a fixed income in March 2026. And every January, you either stand by your mailbox or you open your banking app waiting to find out whether that cost of living adjustment actually translated into something meaningful in your real life. And the answer year after year is nearly always the same. Not really, not in any way that you can actually feel. Well, something meaningful has shifted heading into March 2026. And if you do not take the time to understand what changed and precisely why it changed, you are going to make financial decisions that could cause damage to your retirement for years to come. That is not me being dramatic. That is simply the honest truth. So let us begin with the COLA because that is the figure that captures all the media attention every single year. For 2026, Social Security recipients received a 2.8% cost of living adjustment. The Social Security Administration calculates this number by using the Consumer Price Index for urban wage earners and clerical workers, commonly referred to as the CPIW. They compare the third quarter figures from the previous year and use that comparison to determine how significantly prices have risen, and then they adjust your monthly benefit to reflect that change. On the surface, this sounds completely reasonable and genuinely fair, and on paper, it almost is. But here is the moment where I need you to slow everything down and really absorb what I am about to say, because the headline COLA percentage is almost never the number that actually matters to your daily life. The average Social Security benefit for a retired worker heading into March 2026 is somewhere in the range of $1,176 per month, following the 2.8% adjustment. That works out to approximately $54 more per month than what was being deposited in 2025. Now, $54 is not nothing. I want to be honest about that. But before a single dollar of that money reaches your account, Medicare Part B premiums have already been deducted automatically. And this is exactly the point where the story takes a turn. Medicare Part B premiums for March 2026 are set at $228.90 per month, up from $185 in 2025. That is a $17.90 per month increase. So on one hand, you gained roughly $54 from the COLA adjustment, and on the other hand, you immediately surrendered $17.90 to Medicare. Your real effective raise after everything shakes out is sitting somewhere around $36 a month. That is barely enough to fill your gas tank. That is not keeping pace with what you are actually paying at the grocery store, at the pharmacy, or sitting in the waiting room at your doctor's office. I am not presenting these numbers to alarm you. These are the actual figures, and I want you to be able to look at them directly without flinching or looking away. Now let me address the $2,134 figure specifically because this is a number that has been making rounds and creating a significant amount of confusion, and I want to cut straight through all of that noise. Right now, when people refer to $2,134, they are typically pointing to Social Security disability insurance payments and specific beneficiary categories, where the combination of Medicare premium adjustments and benefit calculations together produce that particular figure. For certain recipients, particularly those whose benefits are high enough that Medicare premium deductions and cost-sharing calculations land in that range, that number is very real and very accurate. But here is what is catching everyone completely off guard in March 2026. It is not that the number exists on paper. It is that the actual amount landing in your bank account after all of the deductions, after all the Medicare costs, after any applicable tax withholding is substantially lower than what is printed on your benefit statement. And the government is not going out of its way to explain that gap to you. The Social Security Administration sends out a benefit verification letter every November. Most people look at the gross amount, feel a brief sense of relief, and then spend the next few months wondering why their checking account balance keeps telling a different story. Closing that gap in your understanding is precisely why I am here talking to you today. There is something else I need to walk you through, and that is a concept called IMA. Because if you have any kind of supplemental income in retirement, whether that comes from a pension, from investment dividends, from part-time work, or from required minimum distributions out of your IRA or 401k, this surcharge could be hitting you right now. And you may not fully understand the reason your Medicare costs are running higher than your neighbors down the street. IRMA stands for Income-Related Monthly Adjustment Amount, and it is essentially a Medicare surcharge that the government layers on top of the standard premium for retirees who fall above certain income thresholds. If your modified adjusted gross income from 2 years ago was above $16,000 for a single filer or $212,000 for a couple filing jointly, you are paying more for both Medicare Part D and Part D than the standard premium in March 2026. The surcharge can add hundreds of additional dollars per month on top of the standard $228.90. And here is the detail that trips people up every single time without exception. They had a one-time income event 2 years prior. Maybe they sold an investment property. Maybe they executed a Roth conversion. Maybe they had an unusually large required minimum distribution during a particular year. And now, 2 full years later, they are being assessed IRMA surcharges based entirely on that isolated income spike. The critically important thing to know here is that you can appeal IMA-A if your income has dropped since then. You complete Form SSA 44. You clearly document the life-changing event that caused that income spike, and you submit everything to your local Social Security office. The vast majority of people have absolutely no idea this option even exists. They simply accept the higher premium month after month and keep quietly writing the check. Please do not do that. You have the right to appeal, and you should absolutely use it. Now, I want to talk about something that connects directly to why March 2026 specifically matters so much, and that is the Social Security payment schedule. Social Security pays benefits 1 month in arrears, and the payment calendar follows the birthday-based distribution system that has been in place since the 1990s. If your birthday falls between the 1st and the 10th of any given month, your payment arrives on the second Wednesday of the month. If your birthday falls between the 11th and the 20th, your payment comes on the third Wednesday. And if your birthday falls anywhere between the 21st and the 31st, you will receive your deposit on the fourth Wednesday of the month. For March 2026 specifically, that means Social Security payments are being distributed across 3 separate Wednesdays throughout the month. The updated benefit amounts reflecting the full 2026 COLA should already be incorporated into every one of these payments. If the amount deposited into your account does not align with what you were expecting based on your benefit verification letter, do not sit and wait assuming it will sort itself out automatically. Contact the Social Security Administration directly. Visit your nearest local office. Log into your personal My Social Security account at ssa.gov and review your complete payment history line by line. You are your own most powerful advocate, and in my experience spanning 3 decades, nobody is going to track down an underpayment or flag a discrepancy on your behalf unless you take the initiative and make some noise. Here is another thing I want to address directly because it comes up constantly in conversations with people in their early to mid-60s and even into their early 70s. Was it actually the right call to claim Social Security when I did? And I want to answer that with complete honesty and with genuine compassion because for many of you, that decision is already behind you and it cannot be reversed. But truly, understanding the mathematics of when you claim helps you navigate every other financial decision in your retirement far more intelligently from this point forward. If you claimed at 62, your monthly benefit was permanently reduced by roughly 25 to 30% below your full retirement age benefit, depending on the specific year you were born. If you held out and waited until 70, your benefit is 24 to 32% higher than your full retirement age benefit, thanks to delayed retirement credits that accumulate at 8% annually between full retirement age and age 70. Here's what that looks like in practical terms. On a monthly benefit of $2,000 at full retirement age, claiming at 62 might yield you $1,400 per month. Waiting until age 70 could produce $2,740 per month instead. The break-even point, meaning the age at which waiting until 70 delivers more in total cumulative lifetime benefits, typically lands somewhere between 80 and 82 years old. If you are in good health and your family history suggests longevity, waiting is almost always the mathematically stronger decision. But I also understand the real world deeply enough to know that not everyone has the financial flexibility to delay claiming until 70. Not everyone can hold out that long without accessing those benefits. And that is completely understandable. What matters most right now is that you have a clear grasp of the framework, because that clarity will help you make sharper, smarter decisions about everything else in your financial life going forward and into March 2026 and beyond. Let me spend a moment on taxes because this particular topic continues to blindside retirees who spent decades assuming that Social Security income would arrive completely tax-free. Up to 85% of your Social Security benefits can be subject to federal income taxation depending on your combined income level. Combined income is calculated by taking your adjusted gross income, adding any non-T taxable interest you received, and then adding half of your total Social Security benefits for the year. If that combined total exceeds $25,000 for a single filer or $32,000 for a married couple filing jointly, a portion of your benefits becomes federally taxable. And at higher income levels, up to 85 cents of every dollar in Social Security benefits can be counted as taxable income on your federal return. This is not some newly invented rule designed to catch you off guard. It has existed since 1983 and was expanded further in 1993, but it keeps surprising retirees in March 2026 because they simply never factored it into their retirement income strategy during their working years. If you're holding substantial balances in traditional IRA or 401k accounts, and those balances are generating large required minimum distributions, those RMDs can push your combined income high enough to trigger taxation on a much greater share of your Social Security. This is one of the most compelling reasons why executing strategic Roth conversions during the early years of retirement before RMDs kick in at age 73 can be such a genuinely powerful planning move. You absorb the tax costs now on the conversion, but you reduce the size of future required minimum distributions. You keep your combined income lower, and you potentially protect a larger portion of your Social Security from being taxed over the long run. And while we are stepping back to view the bigger picture, I want to address something that I know is quietly sitting in the back of your mind because people ask me about it more than almost anything else. What about the long-term solvency of Social Security itself? Is it genuinely going to be there for you 10, 15, 20 years down the road? Here is the honest, unvarnished answer. The Social Security Trust Funds, which consist of the Old Age and Survivors Insurance Trust Fund and the Disability Insurance Trust Fund, have been drawing down their reserves for several years now. The most recent trustees report projects that if Congress takes absolutely no action whatsoever, the combined trust fund reserves could be fully depleted somewhere around 2033 or 2034. Now here is the single most important word in that entire sentence, and it is the word that consistently gets buried beneath all the fear-driven coverage. Depleted does not mean gone entirely. Even if those trust fund reserves were to reach zero, the ongoing stream of incoming payroll taxes would still be sufficient to fund approximately 77 to 80% of currently scheduled benefits. So yes, a reduction is possible if Congress refuses to act, but a complete elimination, no. And the political reality of this country is that Social Security directly touches the lives of over 70 million Americans in March 2026. No elected official from either party is going to campaign on dismantling it entirely. There will be reforms, perhaps benefit adjustments for higher earners, perhaps modifications to the retirement age for younger workers, perhaps changes to the payroll tax cap structure. But for people who are already retired or within close range of retirement age, the probability of catastrophic sudden cuts is meaningfully lower than the headlines and social media posts want you to believe. That does not mean you should ignore the issue. It means you build your plan on realistic, grounded assumptions rather than panic-fueled worst-case scenarios. What I ultimately want you to carry with you after everything we have covered today is this single foundational idea. Your retirement is not just a check that arrives in your account. It is a complete and interconnected system. Social Security is one essential piece of it. Medicare is another. Your personal savings, your investment portfolio, your pension if you have one, your housing situation, your projected healthcare costs across the coming decades. Every single element connects to every other element. Every piece interacts with every other piece. And all of it requires intentional understanding and deliberate management. The retirees who genuinely struggle financially are almost never the ones who had the least money going in. They are the ones who never developed a real plan. They claimed Social Security at the most convenient moment rather than the most strategically optimal one. They never took the time to think through the tax consequences of how and when they would pull from their various accounts. They never sat down to review their Medicare coverage and confirm it actually matched their real healthcare needs and usage. They simply let retirement happen to them instead of building it with intention. And I do not want that future for you. You worked far too hard. You gave up far too much, and you deserve a retirement in March 2026. And beyond that, genuinely feels like the reward it was always supposed to be. The information you need is accessible. The tools to act on it are right in front of you. And starting right now today, with everything you have just learned, you are already standing further ahead than the majority of people who are navigating this exact same challenge without any of this clarity. V,